Hello and welcome back to Dividend Growth UK. Now in the last episode I spoke about the new additions to the ISA since the start of the year. 5 new positions, £8,809 deployed. This one is about what I sold and why. 6 positions, some partial, some complete exits, total proceeds of just over £15,000, all recycled back into higher yielding assets. Now this video is for educational and entertainment purposes only and does not constitute the financial advice. I'm not a financial advisor, always do your own research before making any investment decisions. So this wasn't panic selling, it wasn't a reaction to the market, it was housekeeping. The ISA had started to drift. The lines between what belongs in the ISA and what belongs in the SIPP were getting a little blurry, so I decided to tidy it up. Before I walk through each one, here's the thinking behind all of it. My ISA target is 7% yield or higher. Tax-free income, building every month. That's the thesis, and it hasn't changed. But over time, some positions had run hard. Low yielding stocks that fit the SIPP better are out of the ISA. The share price went up, which is great, but a rising price compresses the yield. So a stock I bought at 7 or 8% was now paying me 5 or 6. Still decent. So the decision was straightforward. Low yielding stocks that fit the SIPP better are out of the ISA. Cash recycled into higher yielding ones. The ISA gets sharper, the SIPP gets first refusal on anything I still believe in. Firstly, there were 3 partial sales. Sainsbury's, Rio Tinto and BP. Now I haven't exited any of these completely, I've just trimmed, took some profit and redeployed the cash. Sainsbury's, £3,000 of profit taken. The share price had performed well, the yield was compressed as a result, and I still like the business. Supermarket income is defensive and the dividend is solid, but at the yield it was paying after the run-up, it was doing less work for the ISA than I needed. So I trimmed and I'm happy to keep holding. Rio Tinto, same story, £3,000 out. Now Rio has been strong, mining royalties, iron ore, copper, the business is genuinely good, but again the yield had moved. I took the profit, kept the position and put the cash somewhere it earns harder. Now BP, £2,700 out. This one I want to be honest about. Yes, the yield had compressed with the price rise, but there's more to it than that. My confidence in the BP's management is low, and it has been for some time. The share price hasn't really recovered to pre-Deepwater Horizon levels, and any rise seems connected with global events, oil price movements, geopolitics, not to actual business performance. So I trimmed a little, and I'm watching. I haven't gone completely, but I'm not adding either. Now the full exits. 3 companies, Vodafone, Bank of Georgia and SSE. These are gone entirely. Vodafone, £2,931. I just want it out. I know the yield is decent and things have been improving. The merger with 3 has changed the picture somewhat, but there was always a cloud hanging over Vodafone, I felt. Constant noise, restructuring, debt, dividend history, and I just began to get tired of it. I redeployed into something I could hold without having to think about it. Bank of Georgia, £2,548 out. This one is simpler. I've made a decision to exit any bank and stocks from the ISA altogether. Bank of Georgia was performing, the yield wasn't bad either, but banking exposure isn't where I want to be in this portfolio, so it's out. And then SSE. This is the most interesting one, a full exit. And I want to be clear, I sold SSE with a profit. Book cost of £11,177, sold for £13,294. A gain of £2,116, 18.9% capital gain plus the dividends I received along the way. SSE is a great company and I genuinely believe in it. Regulated energy networks, renewable generation, it's exactly the kind of long duration defensive business I like. But the yield sits below my 7% ISA target. It fits in the SIPP far better than the ISA. The plan is to rebuy SSE in the SIPP using funds from my incoming workplace pension transfer. Same conviction, just a better wrapper. So what did all of this achieve? £15,178 recycled, 6 positions tidied up. The ISA is now leaner, higher yielding and more focused on the thesis. Every pound from these sales went straight into 5 new positions I covered last episode. PHP, INPP, LMP, AVGI and NVDD, and other high yielding positions I already held. The ISA isn't perfect, it never will be, but it's sharper than it was. And that's the job. So to close, have you ever sold a stock and then regretted it? Or held on when you should have sold? Drop it in the comments below, I'd like to know. If you're investing in an ISA or a SIPP and you're not yet with Interactive Investor, the link is in the description. It's the platform I use for both and you'll get a free year if you follow the link and satisfy the T's and C's. And as previously mentioned, this isn't financial advice. Please do your own research, and I'll see you in the next one. Bye bye now.